Right now, the United States has more than $38 trillion in national debt. That number is not opinion, it comes directly from the US Treasury's debt to the penny data. But here is the question most people never ask. Who actually owns that 38 trillion? And if those holders start selling, what happens next? Because the answer is not what most headlines suggest. When people hear, foreign countries own US debt, they imagine one government flipping a switch and crashing the system. The reality is more layered, and more important. Let's break this down clearly. The United States now owes more than $38 trillion in total federal debt, according to official US Treasury data. But that number is split into two major categories. About $29 to $30 trillion is debt held by the public. Roughly $8–9 trillion is intragovernmental debt. Intragovernmental debt is money the government owes to itself. The largest portion is the Social Security Trust Fund, along with Medicare and other federal accounts. This data comes directly from the US Treasury and the Congressional Budget Office. So when people say America owes $34 trillion, around $7 trillion of that is internal accounting between government programs. Now focus on the $28 trillion held by the public. That is where the real market risk lives. Here is the part that surprises most viewers. The largest holder of US debt is not China. It is not Japan. It is American investors. According to the US Treasury and the Federal Reserve, domestic investors hold the majority of US Treasuries. That includes US mutual funds, banks, insurance companies, state and local governments, pension funds, the Federal Reserve itself. The Federal Reserve alone holds around $5 trillion in Treasury securities, according to its latest balance sheet reports. Now let's talk foreign holders. Foreign investors collectively own about $7 to $8 trillion in US Treasuries, according to the Treasury's international capital data. Japan is currently the largest foreign holder, with roughly $1.1 trillion. China holds under $1 trillion, typically around $800 billion in recent Treasury data. The United Kingdom is also near the top, holding more than $700,800 billion. Now here is where this gets interesting. These numbers fluctuate month to month, but they are publicly reported by the US Treasury. Foreign governments do not own most of US debt. They own roughly 1/4 of debt held by the public. That means about 3/4 of publicly traded US Treasuries are held domestically. The Congressional Budget Office projects that federal net interest costs will exceed defense spending within the next decade if current trends continue. So when you hear headlines like, "What if foreign countries dump US debt?" you need to understand the scale. Even if every foreign holder sold at once, that would impact roughly $7 to $8 trillion worth of securities. Massive, yes. But not the full 38 trillion. Now let's step back. Why does this structure matter right now? Because interest rates are higher than they were for most of the past decade. In 2020 and 2021, the US government was borrowing at near 0% on short-term debt. Today, Treasury yields are significantly higher. The 10-year Treasury yield has been trading between 4 and 5% during parts of 2023 and 2024, according to Federal Reserve economic data. That dramatically increases interest expense. That is not speculation. That is CBO baseline forecasting. So who owns the debt determines who absorbs risk when rates move. If yields rise sharply, bond prices fall. Existing holders take mark-to-market losses. Government interest payments rise on new debt. Now think about Japan. Japan owns over $1 trillion in US Treasuries. According to reporting from Reuters and the Financial Times, Japanese investors have adjusted Treasury holdings multiple times in response to currency pressures and domestic yield shifts. If Japan reduces purchases, the impact is not just symbolic. It affects demand at Treasury auctions. But here is what most people miss. Treasuries are the deepest, most liquid sovereign bond market in the world. When global stress rises, investors often buy Treasuries, not sell them. We saw that during the 2008 financial crisis and during the early 2020 pandemic shock. According to data from the Federal Reserve Bank of St. Louis, Treasury yields collapsed during those crises because demand surged. So the debt structure has two opposing forces. On one side, high debt levels, rising interest costs, foreign geopolitical tension. On the other side, reserve currency status, massive liquidity, institutional domestic ownership. Now let's talk about the Federal Reserve. The Fed's balance sheet expanded dramatically during the pandemic through quantitative easing. At its peak, it held nearly $9 trillion in assets, including large Treasury holdings. Since then, the Fed has been shrinking its balance sheet through quantitative tightening. That means it is allowing Treasuries to roll off without reinvesting fully. So now, private investors must absorb more new issuance. That is the real pressure point. Not a dramatic foreign sell-off, but whether domestic and foreign private investors are willing to keep buying at current yields. According to coverage from Reuters and the Wall Street Journal, recent Treasury auctions have seen mixed demand, with some higher yields required to attract buyers. Higher yields mean higher borrowing costs for the government. Higher borrowing costs mean larger deficits. Mortgage rates and larger deficits mean more issuance. That cycle is what serious macro investors are watching. Now here is the key takeaway. The US debt system is not dependent on one country. It is dependent on sustained global demand for Treasuries as a safe asset. If that demand weakens structurally, yields rise. If yields rise too quickly, financial conditions tighten. That impacts China. Reducing holdings from over $1 trillion a decade ago to around $800 billion today did not collapse the Treasury market. Corporate borrowing, stock valuations, federal deficits. This is why understanding who owns US debt matters. It tells you where fragility could emerge. But sustained declines in overall demand would be different. It also tells you what is exaggerated in media narratives. The system absorbed it. And that is what we will explore next. Because Japan is the largest foreign holder. And if Japan changes course, the consequences would ripple through currency markets, bond yields, and global capital flows. In the next video, we are going to break down exactly what would happen if Japan stops buying US Treasuries. If you want to understand where real systemic risk could come from, that is where we are going next.